Glenn, great to be here with you and have the chance to discuss some of the investment topics, and I'm sure we've got quite a lot to cover, so I'm just going to get straight into it. You spend a lot of your time offshore investigating investment managers overseas, and obviously one of the big themes has been quantitative easing and this wall of money that we see flowing from central banks. I just wanted to get your perspective from the investment managers that you meet with regularly on is this doing the job to heal the world economy, especially in the developed world? And if not, what are some of the implications further down the road that might come of this quantitative easing that we've seen on such a large scale?
So I think the views out there are very polarized. We have certain people who like it. They're saying that things are bad and therefore this is necessary, and this flood of money is driving asset classes higher and therefore wonderful. You'll see it in lower bond yields, and in other words, higher bond returns. You're seeing it in equities going up and commodities going up, etc. On the other side, we have people saying it's the end of the world and it's the worst possible thing they can do. I think it'd be fair to say that even the central bankers of the world themselves would say this is unprecedented. People haven't tried this before. It's an experiment. Dangerous times or difficult times call for these type of measures. And so we're not sure what the consequences will be, and we're just seeing unbelievably polarized views and impressions out there.
Okay, because you get the sense when you look at Ben Bernanke speaking at the FOMC and testimony before Congress that it seems to be controlled and everything seems to be clearly thought out, but you're kind of suggesting that the perception is from very sophisticated managers that they're not quite sure that the Federal Reserve and Bank of England know exactly what's going to happen in this experiment on such a large scale.
Absolutely, they have no idea what's going to happen. But the sense is that they had a greater evil they had to fight. We had the 2008 global financial crisis. Things were falling apart. The global financial system was being attacked very severely, and so they had to bring these measures in. But there's no talk, there's no discussion of them ending. I mean, we had QE, which was this new term, quantitative easing. We now had to call it QE1 and 2 and 3, we're up to QE4 now. And why not 5 and 6 and 7, down the line. So I think it is kind of problematic. Interesting, in the recent Fed minutes, there was some discussion about the fact that they may have to stop this easing before the year is out, before 2013 is out, but let's wait and see. But it's not just them. I mean, Bank of England, Bank of Japan, the Chinese as well, everyone's kind of playing these games. So there's a lot of liquidity sloshing around markets.
Well, one of the effects that many people are talking about further down the road is the rise of inflation and severe inflation at some point. Is that something that's worrying investment managers at the moment?
Again, I'd say that those managers who quite like QE are saying it's driving markets up now and we're happy. Those, I think, who are taking a longer term view and don't like it are saying absolutely the consequence of these are going to be felt probably in inflation. And I think they may already be being felt, because you've got inflation in many different areas. You've got goods inflation, which seems to be under control in most of the developed world, although there's a lot of adjustments made to these inflation numbers over the time. Greenspan implemented hedonic adjustments and other funny things that they do to that. There's a company called Shadow Stats that runs the same series of inflation numbers in America as we've always done before all these adjustments were made, and they show inflation in America running between 5 and 7%, not 1 and 2. That kind of makes a lot more sense. If you speak to most people, they always think that inflation numbers are understated, and they probably are. But you also get inflation at the asset class level, and we're seeing inflation in these bond yields going down to unbelievably low levels, so prices going high in commodities and in equities more recently. So I think there's evidence of inflation everywhere we look. And then obviously in emerging markets, we know there has been inflation. I mean, inflation may well have been the cause of a lot of these Arab riots and the things that took place there, because food inflation went very, very high. So I think inflation is actually very, very evident. The only place it's not evident is in the published CPI numbers of the developed countries.
Should we be skeptical then of those numbers? Because, this is quite an important point. They do these statistical adjustments to these numbers. And, we've seen it in South Africa. Inflation apparently is at, just under the benchmark for the Reserve Bank, which is 6%. But if you're living in Joburg, I would argue that inflation's almost been twice that over the last few years. Is it something to be cautious about using the official number?
If you think about it, and I'll give you the best example I can think of would be Japan. Japan pays on their 10-year bonds about 80 basis points. If they paid 100 basis points, they already are spending 25% of their budget on, paying the interest on their debt. If we went up to just another 20.2% higher, it would probably be something like 50% of their budget. So I don't think many of these countries can afford to have inflation numbers appear higher. They can't afford interest rates to be much higher. So I think there's enormous incentive to keep those numbers down. So I would be a little bit skeptical, sure.
Okay. Just turning our attention, I guess, to prospects overseas. Let's talk about the Americans. They seem to have an economy that's slowly starting to find gears. How are managers finding it there in terms of valuations as well, finding attractive places to invest in the equity market?
So you want to talk US specific now?
Yeah.
Yeah, I think it's interesting. I mean, if you talk about kind of different regions of the world, the place that definitely seems to be recovering the best and the most is the States. I mean, their housing market fell by well over 40% for 5 years. It seems to have bottomed. It certainly seems to be picking up. I would go along with that. I think all the steam, the froth has been taken out. Whether or not you get a very strong recovery, a very sustained housing price recovery, I'm not 100% sure, but the worst I think we can say has been seen. And there are other evidences in the US economy of some improvements. Job growth has picked up, although when one looks through the numbers, there are other distortions within these numbers. For example, the quality of the jobs that are being created needs to be assessed. I mean, if you had a job as a high-flying banker and you're now flipping hamburgers at McDonald's, it's a job for a job, but it's really not the same. So a lot of the jobs that have been created have been very, very low-paying jobs, almost at the lowest level. And I think that's kind of problematic. And there's other adjustments that they make to the numbers as well. I mean, again, shadow stats on the same basis. If they took unemployment numbers in America, which are currently recorded at 7.8%, and make none of these other adjustments, they get an unemployment level of 22% in the States. That's 1 in every 5 Americans is unemployed. We have, I think the number is 17 million people in America living on food stamps alone. 50% of Americans actually live off the public teat. They have to be supported by the government of America. It's not even, we know about welfare states in Europe. We're talking about America now. So I think what's happening is there definitely is a recovery taking place, there's no question. I think Wall Street is doing pretty well, but Main Street, the broad economy, I think there are swathes there that are in real trouble.
And that's obviously, I imagine, not making the job of investment managers that you're using or picking to trying to find value in those markets. In terms of overall sector allocation, is the US equity market and bond market for that matter becoming a smaller piece of the sort of pie when you look at your portfolio from the top?
Yeah, I think that'd be a fair comment. I think America would sit at maybe 55% of a global index. And there are very few managers that you'll find that would be overweight that. It's a very, very large exposure. Many, for example, in a world index which has no exposure to emerging markets, would have an emerging market exposure. And a lot of that would be funded from the States almost by definition. It's the biggest weighting, and if you want to put 10% to emerging markets, you almost have to take it from the States. And it's a big weighting anyway. So I think a lot of people are quite bullish on the recovery taking place in terms of the economy in America. It's certainly much better than seeing Japan. It's certainly much better than seeing in Europe. It's obviously not as good as the growth in emerging markets, which have been a lot stronger and continue to do so. So I would say managers are underweight America, but I'm not so convinced that they're negative on America per se, but just the weighting in the index is maybe too big.
It does seem to be a bit of a dichotomy because we see many investment managers locally finding value in some of the bulge bracket blue chip companies offshore. So while there seems to be, the economy struggling a little bit, valuations might look fair in the States, but there's still some investment managers finding the opportunities. I think we're still dealing with a two-tier world economy at this point, and I know that you've been doing a lot of work around the BRICS. You and your chief strategist have recently returned from Brazil and India. What's the sort of sense on the ground in places like that around prospects, and are they able to grow through this despite what's happening in the developed world?
So, I'd never been to Brazil beforehand nor to India, so these were kind of, give me a little bit cautious that a 2-week trip and seeing 30-odd companies and government officials, etc., gives you a complete view. But our views were nevertheless, I think, very strongly impressed on our minds. Brazil has grown in the last 10 years about the same as South Africa. So not particularly strong growth, 2 to 3% type of level. And it's a country with full employment. So there's very little unemployment, 5 or 6%, which is pretty full employment for a country like that. And I didn't see enormous growth opportunities there. Wonderful country, rich in resources as South Africa has, great energy, lots going for it, dominant in its area, enormous oil reserves off the coast, of Sao Paulo, etc., which they're accessing very deep resources, but they're accessing it. So there's a lot going for Brazil, but not exciting growth opportunities. India was exactly the opposite. I mean, the growth opportunities are enormous. And I think that country, which for 100 years grew at 1%, and then since independence grew at 3 to 5%, is now growing 5 to 7%. There are a lot of macro concerns. The government has huge amount of debt. They got huge unemployment, poverty that they have to kind of deal with. But in terms of growth and opportunities, we met companies who can grow for decades to come and not reach the entire subcontinent, because there's 28 different states in India, and I think if you've done well in one, that's not bad. Crossing the boundaries into the next state is actually quite difficult. So huge growth opportunities.
You talk about how they've moved for 100 years. They grew very anemically at 1%. What's changed in the last decade or so that's allowed this surgence in growth? Has it really been the getting the private sector involved in the economy and removing some of the constraints around private enterprise?
I think that's exactly, the 100 years where they grew so poorly was under British control, under British rule, and they grew a lot stronger under independence. But what really changed for them was 1991, where they had a debt crisis. And in fact, they were only weeks away from going insolvent. They'd run out of reserves, they had to go to the IMF to be bailed out, etc. And because of the crisis, changes were made to the economy. These things called the license Raj that had been in place, that controlled the entire economy, were broken down. They brought private enterprise in. They moved away from nationalization to privatization, and their growth just accelerated. And I think that's one of Chris and my concerns now, is if they continue with that type of process, good. If they don't, you could see that rate of growth diminish again.
Now, what does that mean for a multi-manager like you when you talk about Brazil and India, and both regarded obviously as part of the BRICS, but two different prospects? Does it mean there are better investment opportunities in the one, like India, than the other?
I think so. I think you have more 100 baggers or 10 baggers or great company by company opportunities you're going to see in India than in Brazil. I left a lot more excited about India in terms of investment prospects, and not only from that perspective, but as a South African. We found Brazil very foreign. It's Portuguese, it's very insular, because actually they're bounded by the Amazon, and they can't actually be attacked, whereas India is very, very open. It had British, so it's got the English language, the British rule of law, and it was very, very familiar. And there's a lot of South African companies that have gone across quite successfully. There's a lot of Indian companies that have come to South Africa quite successfully. And when we ask, for example, Brazilian companies, did the BRICS mean anything to you? Brazil, Russia, India, China, South Africa, do you trade with them? They say, guys, irrelevant. We just, we only think about if it's in Africa, Mozambique and Angola, because they speak Portuguese. The rest is not particularly relevant. That wasn't the case in India. I think the Indians are very interested in South Africa and Africa. And I think South Africans are very interested in a number of South African corporates are making quite a big play in India.